On October 16, 2001, a junior analyst at a hedge fund in Midtown Manhattan circled one line in Enron's quarterly earnings release with a red pen. The line read, $1. $2 billion equity write-down related to certain investments. Asterisk. His note in the margin, why now? Asterisk. It was a Tuesday morning. Enron's stock was still trading. The Houston headquarters still had its soaring glass atrium, the kind of lobby designed to make you feel like you were standing inside the future of American business. 11,000 people still showed up to work that morning. The elevators still ran. But somewhere in that building, a thread had just been pulled. And what the thread was attached to, nobody outside a small circle of executives fully understood yet. The document is dated January 30th, 1992. It's a letter from the Securities and Exchange Commission to Enron's legal team, confirming that the company had been granted permission to use mark-to-market accounting for its natural gas trading contracts. Enron had lobbied hard for this approval personally through Kenneth Lay, who had pressed the case with SEC Chairman Richard Breeden. The approval took about a year to secure. Most people who covered Enron at the time didn't notice it. It looked like a technical accounting change for a pipeline company. It wasn't. Here's what mark-to-market means in practice. The moment you sign a long-term contract, say, to supply electricity to a utility for 20 years, you book the estimated profit from that entire contract on this quarter's income statement. Right now, today, before a single kilowatt has been delivered. The logic is defensible. The contract has real economic value. The problem is that the number you're booking is built on assumptions future energy prices, delivery costs, inflation rates, counterparty risk that no one can verify until the years actually arrive. And at Enron, the people making those assumptions were the same people whose bonuses were calculated on how large the resulting number was. That's not a rogue accounting choice. That's an incentive structure. And incentive structures tend to produce predictable outcomes. By the mid-1990s, Enron was booking revenues from contracts that spanned decades. The profits appeared in the current quarter. The cash would arrive, if it arrived at all, over the next 20 years. On the income statement, Enron looked like a machine. In its bank accounts, the picture was different. By 1997, that gap between what the accounting said and what the cash flows showed had produced a number so large, so disconnected from anything physical, that one internal accountant quietly flagged it in a memo to his supervisor. The memo was buried. We found it. Experienced financial analysts have a habit that Enron's investors largely abandoned during the late 1990s boom. They compare net income to operating cash flow. Net income is what the accounting says you earned. Operating cash flow is what actually moved through your bank account. In a healthy business, they track each other reasonably closely. When they diverge, when income grows while cash lags far behind, it's one of the oldest warning flags in financial analysis. At Enron, through the late 1990s, that gap was widening. So Enron's finance team built a structure to manage the appearance of the balance sheet. These structures were called Special Purpose Entities, SPEs. And whoever named them gave them, improbably, names from Star Wars. Chuko, J-E-D-I, LJM Cayman. Think about that for a moment. Someone in Enron's finance department, a lawyer, an accountant. An executive sat down to name a shell company and typed Chuko. This wasn't a small team of rogue operators working in secrecy. This was a culture that had so thoroughly normalized financial engineering that it had turned it into an inside joke, a game with a lightsaber aesthetic and a balance sheet purpose. Here's what the game was. If an Enron investment was losing value, a broadband venture, an international power plant, a trading position gone wrong, it could be sold to one of these SPEs. The SPE would borrow money to buy the asset at a price that removed the loss from Enron's books. The debt the SPE took on wouldn't appear on Enron's financial statements. The transaction made Enron look cleaner than it was. $63 billion in assets at Enron's peak. More than the entire GDP of Ecuador at the time. More than the combined value of every major U.S. airline. A number that large requires a structure capable of hiding meaningful portions of it. And the SPEs were that structure. The legal requirement was that SPEs be genuinely independent. Outside investors had to own and control them. But in practice, Enron's SPEs were often capitalized, partly with Enron's own stock, managed by Enron's own executives, and backstopped by Enron's own guarantees. The independence was a legal fiction dressed up in corporate paperwork. The CFO managing much of this structure was Andrew Fastow. In February 1999, Fastow stood before Enron's board of directors and presented the LJM partnership, a structure he personally managed and from which he personally stood to earn fees. The board had to vote on a waiver of its own conflict of interest policy to allow it. The board voted yes. Later, in the depositions and court filings, investigators asked the board members what questions had been raised in that room. The answers were thin. There had been a presentation. There had been assurances. The vote had been brief. Fastow walked out of that meeting with a waiver in hand and a structure in place that would generate tens of millions of dollars in personal fees paid to him from entities that existed primarily to serve Enron's balance sheet. Nobody in that boardroom stopped it. There is a question that runs through every major accounting fraud, and it always gets asked in the same way. Where was the auditor? Asterisk. In Enron's case, Arthur Anderson was in the room. Anderson had audited Enron's books for 16 years. It was also, simultaneously, one of Enron's most significant consulting clients, earning roughly $25 million a year in audit fees and another $27 million in consulting fees from the same company it was supposed to be independently checking. In plain terms, the firm being paid to check Enron's math was also being paid by Enron. Nobody in that arrangement wants to find a problem bad enough to end the relationship. This is what regulators call an independence problem. It doesn't require explicit corruption. It operates through something quieter, a gradual accommodation to the client's preferred interpretations, a tendency to resolve ambiguous accounting questions in the direction of the relationship rather than against it. Anderson did raise concerns internally. Documents later reviewed by investigators showed that some Anderson partners had flagged the accounting treatment of specific SPEs. Their concerns were managed. The audit opinions continued to be clean. Then, in October 2001, when Enron's problems became public, Anderson employees began shredding documents related to the Enron audit. Not a few pages, tons of paper. According to testimony, plus the systematic deletion of electronic files. The obstruction of justice conviction that followed effectively ended the firm. Not because the conviction held the Supreme Court overturned it in 2005 on a legal technicality involving jury instructions, but because clients had already left. Partners had already gone elsewhere. 100-year-old institution had dissolved in months. The Anderson collapse told the accounting profession something specific. The structure of the industry itself, where audit firms also consult, where fees flow from the client being checked, where partner relationships with clients run for decades, had produced a warning system that failed systematically. That structural lesson would eventually become law. But in the autumn of 2001, it was still officially just Enron's problem. Sharon Watkins was a vice president at Enron. She had worked in accounting. She understood the SPE structures from the inside. In August 2001, she wrote a memo directly to Kenneth Lay. "I am incredibly nervous," she wrote, "that we will implode in a wave of accounting scandals." She named the structures. She named the risks. She put in writing to the CEO of the company what the numbers actually meant. Lay forwarded the memo to Enron's outside law firm. The law firm reviewed it and produced a legal opinion concluding that the accounting, while aggressive, was defensible. The memo did not trigger an external investigation. It did not stop the quarterly filings. It did not reach the board in the form it deserved. What broke the situation open wasn't an internal warning. It was something that came from the outside and almost by accident. In March 2001, a reporter named Bethany McLean published a piece in Fortune magazine. The headline asked a question that seemed almost naive at the time. Is Enron overpriced? Asterisk. McLean had done something simple. She'd asked how exactly. Enron made its money. She'd read the filings. She'd called analysts. She'd found that the answers were vague in a specific way. The kind of vague that comes not from complexity, but from deliberate obscuration. The article ran. Enron's CEO at the time, Jeff Skilling, called McLean's journalism unethical. Wall Street analysts, most of whom had buy ratings on the stock, did not meaningfully revise their positions. The information existed. It was published. It didn't travel. Then October arrived. Enron announced its quarterly results. A loss. A $1, $2 billion write-down, and a restatement revealing that its equity had been overstated by hundreds of millions of dollars due to accounting corrections connected to the SPE structures. Loss plus restatement. That combination sends a specific signal to any analyst who has seen it before. The previous numbers were wrong, which means every quarter built on those numbers was wrong, which means the question is now, by how much and for how long? The SEC opened a formal investigation. Within weeks, Enron's stock, which had traded above $90 per share just a year earlier, was in freefall. And here is where the SPE structure became a trap of its own design. Many of the partnerships had been guaranteed against loss using Enron's own stock as collateral. As the stock fell, the collateral deteriorated. The guarantees collapsed. The structures that had been built to protect the balance sheet now accelerated the spiral. There was no floor. In December 2001, Enron filed for bankruptcy. At the time, it was the largest corporate bankruptcy in American history. The question that Enron's employees asked first, and the one that still gets asked, is the most direct one. Where did the money go? Asterisk. The honest answer is complicated, and it matters to get it right. A significant portion of the lost value was never fully real. Enron's peak market capitalization of roughly $90 billion was a stock price multiplied by shares outstanding, a number that existed because investors believed the earnings projections, which the accounting had made appear far more certain and profitable than the underlying business could sustain. When the belief collapsed, the market value collapsed with it. That $90 billion didn't move somewhere else. A large portion of it had never existed as a tangible, touchable asset. But some of the money did go somewhere specific. Executive bonuses, paid in cash when the stock was high, were real. The fees Fastow collected from the LJM partnerships, eventually estimated at over $30 million, were real. Stock sold by executives before the collapse, through transactions that drew intense scrutiny during subsequent investigations, produced real proceeds that ordinary shareholders did not share. And then there were the retirement accounts. Enron's 401k plan was heavily weighted with company stock, in some cases because employees had been encouraged to hold it. In others, because of how the matching contributions were structured. In the weeks of the final descent, the plan was under an administrative lockdown, a scheduled transition between record keepers that prevented rank-and-file employees from selling their positions. The lockdown lasted approximately 30 days. During those 30 days, the stock lost more than half of its remaining value. Congressional investigators later established that during that same period, executives with direct stock sale transactions were not subject to the same restrictions. Some employees lost everything they had put away. The criminal prosecutions that followed were extensive. Fastow pleaded guilty and cooperated with prosecutors. Kenneth Lay was convicted on 6 counts of fraud and conspiracy. He died of heart disease in July 2006. Before sentencing, Jeff Skilling was convicted on 19 counts and served more than a decade in federal prison before his sentence was reduced following a Supreme Court ruling on a related legal question. Every collapse leaves a paper trail, and eventually, a law. In July 2002, 7 months after Enron's bankruptcy filing, 3 weeks after WorldCom announced its own $8 billion accounting fraud, Congress passed the Sarbanes-Oxley Act. The speed was unusual for major financial legislation. The political pressure was not. 2 companies of that scale, with that many employees and pension holders, had collapsed within months of each other. The argument that these were isolated incidents had become untenable. Sarbanes-Oxley did 4 specific things that the Enron failure had exposed as necessary. It required the CEO and CFO of every publicly traded company to personally certify the accuracy of their financial statements. Before SOX, executives could claim, and did claim, that they hadn't reviewed the numbers closely enough to be personally responsible for them. After SOX, certifying a false statement became a specific federal crime with specific personal criminal liability. The plausible deniability was closed. It created the Public Company Accounting Oversight Board, the PCAOB, a new federal body with authority to regulate and inspect accounting firms. Before this, the profession had self-regulated. The Anderson dissolution made the case for independent oversight impossible to argue against. It drew a hard line between audit and consulting relationships. The firms checking the books could no longer simultaneously sell the full range of advisory services to the same clients. The exact conflict that had compromised Anderson's independence with Enron became a regulatory boundary, and it created formal whistleblower protections, explicit legal shelter for employees who reported financial concerns in writing, with specific retaliation prohibitions, a direct answer to what had happened to Sharon Watkins, who had written her memo and watched it be managed rather than acted upon. Did it solve the problem? The 2008 financial crisis arrived 6 years later. It demonstrated that the financial system still contained structural vulnerabilities that Sarbanes-Oxley had never been designed to address in the securitization market, in the shadow banking system, in the ratings agencies that assigned AAA grades to instruments they didn't fully model. Those weren't publicly traded corporate frauds. SOX wasn't built for them. But the specific failure modes that Enron demonstrated opaque related party transactions, mark-to-market assumptions that no one was independently verifying, auditors with too much financial interest in a clean opinion, no personal accountability for executives who certified the numbers. Those specific gaps were closed. That junior analyst in Manhattan, the one who circled the line in red, he told his colleagues the write-down made no sense, not because the number was large, but because of the timing. If the loss had been building for years, why was it disclosed now, this quarter? Framed as routine, his firm cut its position. Not everyone did. What Enron demonstrated more precisely than almost any other collapse on record, is that the systems designed to catch fraud are not neutral. They have incentive structures of their own. Auditors who earn fees, analysts who earn banking business, boards who earn goodwill, executives who earn bonuses. Each of those incentives, individually, is unremarkable. Together, they can produce a machine that runs for years in a direction no single person fully intended, and that stops only when a specific disclosure can no longer be explained away. Sarbanes-Oxley tried to answer a structural question. How do you design a system where the people inside it have more to gain from honest disclosure than from looking the other way? That question doesn't have a permanent answer. It requires constant revision. Every financial crisis since has found a new place where the incentives had drifted out of alignment. But the paper trail Enron left is now embedded in every CEO certification, every auditor independence rule, every whistleblower protection in American corporate law. Every collapse leaves a paper trail. We followed it,